Hi, I'm Jimmy. In this video, we're going to look at Chevron, ticker symbol CVX. So first, we're going to look quickly at Chevron's business. Then we're going to run through some of their numbers, some recent updates, and then we're going to try to come up with a fair value for Chevron stock to see if it's worth buying today. So when we jump over to the Investors Grow website and check out Chevron's business segments, well, we can see that they have an upstream and downstream business. Upstream is when companies drill for oil and gas, extract it, pull it out of the ground, things like that. Downstream is when they refine it and they sell it to end customers. And we might notice that their downstream business dominates their upstream business. Although when I dug a bit into their financials, their upstream business actually generates about as much profit as the downstream business does. So upstream is a bit more profitable, although downstream, they generate more revenue. So we should keep this in the back of our minds as we run through the rest of the business. So right in line with this, well, back in 2023, Chevron announced that they are acquiring Hess, ticker symbol HES. Now, this acquisition is already getting some of the approvals that they need. There's been some approvals that have been gone through and some that still remain to go through. And it's expected to close somewhere at about the midway point of 2025. So we'll come back to this potential acquisition in a second when we go through some of the numbers. For now, let's jump in and look at Chevron's revenue over the past year. And we can see that revenue, broadly speaking, has been trending higher, but there is a decent amount of volatility from one year to the next. Now, I'm sure it's fairly obvious to many people that clearly the volatility in their numbers is largely tied to what's happening with the underlying commodities, things like oil and gas, the oil and gas that they pull from the ground, and ultimately what they're able to sell those refined products for. And to illustrate that, let's overlay crude oil prices on top of the revenue chart. And we can see when we overlay crude oil prices, well, we can see that, let's say back in 2022, when crude oil prices were very high, well, clearly higher crude oil prices led to higher revenue for Chevron. Well, the same could be seen true. The same is true just a couple of years before when oil prices were on the lower end. Well, Chevron's revenue was on the lower end. So clearly, commodity prices are going to play a huge role in Chevron's growth and profitability. Okay, now with this in mind, let's jump over and look at a flow chart for Chevron's income statement. So here's how we can read these charts. Basically, this chart starts with revenue and it works its way down. The idea is that we follow the green line right on to the end. The wider it is at the end, the better. In this case, we're left with about 8.7% profit margins. So basically, this means that 8.7% of revenue is converted into profit. Now, when we jump over and look at a historical chart of net income profit margins, well, we can see that their most recently completed year, this 8.7% is about in line with their long-term average. Give or take, this is right around where we would expect them to be. But when we jump over and look at Hess's, now we're going back to that Hess deal that they have. When we look at Hess's profit margins, well, the recent year is clearly on the higher end. In fact, the past few years are on the higher end when it comes to net profit margins. So in theory, if they were to combine with Chevron's business, this has the potential of pulling Chevron's net profit margins higher, which again is a good sign for investors. Okay, now with all that in mind, let's jump back to our chart of revenue, but this time we're going to add analyst estimates to try to gauge where analysts think revenue is going to be over the next couple of years. So all of these charts are on the Investors Grow website along with the analyst estimates. And as you can see in this chart, analyst estimates, they're the green bars. Well, it looks like analysts are expecting for revenue to be, give or take, about flat. Okay, now how about free cash flow? Now, free cash flow is important because we could use free cash flow for discounted free cash flow to try to come up with a fair value for Chevron stock. Now, I would point out that if we're going to use analyst estimates for free cash flow, a lot of times it's important to know how many analysts are coming up with each line. So each bar, how many analysts are projecting each individual bar? So how many analysts are projecting a single year's numbers as far as free cash flow is concerned. So we can see that when we mouse over on the Investors Grow website, when we mouse over each individual bar, it tells you how many analysts contributed to that year's projections. So clearly we've got a few analysts over the next few years. And when we try to draw a broader trend line for free cash flow, it does look like free cash flow estimates are heading slightly in the right direction, not at a rapidly increasing pace, but it is trending higher. Now, if we use these analyst estimates to try to come up with a fair value for Chevron stock, well, on the Investors Grow website, it does the calculation and tells us that the stock is worth a bit over $200 per share right now using those free cash flow estimates, which isn't bad considering that the stock is currently trading at about $150 per share. So I used a required return of about 9% to come up with this $203 fair value. But if you think that that number should be higher, well, that's what this implied return tells us on the Investors Grow website. Basically, if we were to set that required return to be exactly 11.1%, well, the fair value and the current price would equal. So that's what that number tells us. Okay, so with discounted cash flow, Chevron looks slightly undervalued. Now, the tricky part with discounted free cash flow for many energy companies is that because the company's free cash flow and profit and revenue, for that matter, all are so driven by the price of the underlying commodities, well, because of that, we could imagine that commodity prices are notoriously difficult to forecast. So a lot of times I think it makes sense to confirm our fair value numbers with another valuation method. Something like enterprise value to EBITDA could work, or even something like price to earnings could work. So to keep this simple, let's jump over and look at the price to earnings chart for Chevron stock, again, going back the past few years. Okay, so we've got two lines on this chart. The blue line is the quarterly PE ratio for Chevron stock, and the orange line is the industry average. The industry, in this case, is integrated oil and gas. So we can see that over the past few years, Chevron is trading slightly higher than the industry average, which is implying that the stock could be a bit overvalued. Now, when we add Chevron's own 5, 10, and 20-year averages to this chart, well, we can see that overall, the Chevron looks slightly overvalued, but with their 10-year average, well, the stock looks about fairly valued. So that's something to consider. It looks like PE has it slightly overvalued to about fairly valued, while discounted cash flow has it undervalued. Okay, now let's jump over and look at Chevron's dividend history. So this is a chart of Chevron's dividend history going back the past 20 years. And we can see that, broadly speaking, they've done a good job of increasing their dividend. The only real pause came back in 2015 when let's say they hesitated on increasing dividends during that time period. To better understand why they paused here, well, here we can jump over and look at free cash flow coverage. Basically, how much does free cash flow cover their dividends? And we can see that during that time period, they had some trouble covering their dividend with free cash flow. So it kind of makes sense that they would pause at that time. But again, broadly speaking, they've done a fairly good job of increasing their dividend. Now, with all this in mind, let's jump over and look at the bull and bear analysis of Chevron stock. On the bullish side, well, Chevron stock does look a bit undervalued using discounted free cash flow. So clearly, this is a good sign. Now, they're also working on their expansion in the Tengiz oil field over in Kazakhstan. And although there's still some hurdles left in this project, this is supposed to be a long-term growth project for them. And this is likely a good sign for the business. Then we should give them some credit for paying a fairly reliable dividend and doing a good job with asset allocation, paying dividend, increasing the dividend only when they're able to. Then they have the Hess deal. Now, if the Hess deal closes when they think it's going to, again, in 2025, that's expected to close. Well, if that does happen, that's likely to be a long-term value add for the business. Now, as far as the bearish side goes, well, I think it makes sense to jump over and look at Chevron's net income chart. This is their net income chart, just straight up. And this is one of my bigger concerns about not just Chevron's, but many energy companies. Now, energy companies oftentimes have a difficult time staying profitable, especially when oil and gas prices drop and there's some general hesitation as to whether or not these types of businesses can maintain long-term profitability like many other industries. So I think that this fairly inconsistent profit over the past decade can lead to, let's call it, inconsistent growth within their profit margins, and that's likely to weigh on the stock in general. Plus, there are some geopolitical concerns with Chevron's business in general. So one example of this is going back to that Tengiz oil field over in Kazakhstan. Well, most of the oil and gas that ships out of that region is done through a pipeline that leads to the Russian Black Sea port. And as we might imagine, given the current political climate that Russia is in, well, this could put on some additional pressure on Chevron, and a lot of that's out of their control. Now, this pipeline has continued operating through the past few years with only a few disruptions along the way, But again, this is something to keep in the back of our mind. Now, overall, I think that Chevron runs a very strong and efficient business and looks like it could be a good long-term investment if somebody is looking for an integrated oil and gas company that pays a semi-reliable dividend, that over the long run, this company is one of the premier oil and gas companies within the entire industry. And I think Chevron is something to consider if we need this particular piece in our portfolio. Now, if you'd like to sign up to get access to the Investors Grow website, I'll leave a link in the description below. And if you're curious how to research stocks, I actually did a video called 8 Steps to Analyze a Stock. I got a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.